We've got Deputy Governor Subir Gokaran joining us on the show. Mr. Gokaran, to begin with, you've surprised the markets with a higher than anticipated 50 basis point cut on the repo. Tell us what the rationale behind the aggressive move is, because you've also mentioned that the space for further reduction in rates is limited given the sticky nature of inflation.
Well, it's for people to decide whether it's an aggressive move or a surprise. We based it on the perception that the current growth inflation scenario, which is essentially that growth is slowing and inflation is moderating, there are risks on both. There are risks that growth will slow further. There are risks that inflation will harden again. Both of these are things that we take into consideration. But in our baseline scenario, the balance of growth and inflation risks is such that it warranted some downward adjustment in interest rates in the policy rate. And when we looked at what was the appropriate adjustment, we thought of doing nothing. Of course, was always an option, but 25 now and a 25 sometime later versus a 50 now, and we felt that it was the best thing would be to bring it forward to do the entire 50 at one shot. This does not mean that nothing will be done after this. I don't think that's the right signal to read from the policy. But we have signaled that given the overall growth inflation scenario, that the room for easing is limited. It's not zero, but it is limited.
You know, Mr. Gokaran, you've also said that supply-side pressures taken by the government, while of course in the right direction, may not have had an immediate impact. Do you believe that the government needs to move faster on these issues?
I think the immediate requirement on the government's part, which is something they've made very explicit in the budget speech and statements following the budget, is that fuel prices need to be increased. They need to be corrected. There is just too much of an imbalance that is being generated in the economy because fuel prices have not been corrected. This is reflecting in the fiscal situation. It's reflecting in the balance of payment situation. So there are many reasons why a correction is imperative. And once that correction is achieved, it will immediately have of course, it will have some mathematical impact on inflation, on headline inflation, but it will also help to curb demand, to rein in demand, because it will help to bring the deficit down, which is what the budget has committed to. So we want to see that, or we would like to see that adjustment being done. That's the immediate step. The supply side measures, initiatives to increase productivity in dairy, for example, or programs to speed up infrastructure investment. All of those are important, but you know that they will take some time to materialize, and you cannot expect them to deliver results overnight. But on these price adjustments and the very significant impact that it will have on the overall demand pattern, because it is really stimulating or helping to stimulate consumption by allowing people to pay less than what they should be for their fuel requirements, their energy requirements. That's an important correction. That's something we hope and expect to see fairly soon.
Sure. Now, you've also spoken about the potential of the high government borrowing program crowding out private investment, and also that the budget estimates for subsidies may well actually be breached. How worried is the central bank about the government sticking to the projections that it made in the union budget?
Those are risk factors. We do not want to underestimate or to ignore the risks of the budget estimates not being met. But for the moment, we are working on the presumption that the budget commitments will be met.
Mr. Gokaran, bankers don't seem to be very confident of meeting that 16% deposit growth projection. How grave is the concern, really, over slack deposit growth in the banking system?
Well, when we talk to bankers about it, a number of reasons are offered. There are more attractive alternative channels, including gold, that interest rates on deposits are simply not generating the kind of demand for deposits as used to be the case. There's a number of reasons. There isn't one specific reason. Now, obviously, if deposit growth lags significantly below credit growth, that creates a structural liquidity problem in the system, and that's a kind of scenario we've been dealing with for some time now, apart from other pressures on liquidity. So we have to address it both from the viewpoint of liquidity management and ensuring that banks are doing the kinds of things that they need to do in order to generate deposits. Now, this is a business. Banks are in the business of raising deposits. It's not something for the regulator to tell them how to do. But if there are constraints to deposit mobilization emerging from the regulatory side, I think those are something we will address as the need arises.
Right, and finally, the Reserve Bank of India seems to be coming down fairly strongly on gold loan NBFCs. Tell us what's the reason behind this? What's the concern at the RBI?
The gold financing NBFCs is concentration risk. That is, these are businesses that lend money against a single asset. And so they are particularly vulnerable to any significant volatility, particularly downward movements in the price of this asset. So that calls for somewhat tighter prudential requirements, and that has really been the motivation for the kinds of steps we have taken to bring these higher prudential standards into this industry. There are, of course, other issues relating to customer service and so on, some of which we've also been sensitized to and have taken some actions in that regard.
Subir Gokaran, thanks very much for coming in on the show and actually taking us through all the actions of the RBI in the annual monetary policy.